Hey, what's going on, everybody? Welcome to the show. Today's episode, we've got an amazing guest. He's a young gun, man. Young gun in the tribe. His name is Ryan Stenberg. He's an investor. He's an entrepreneur. He's doing incredible things. I'll say in the real estate space, I guess, or at least affiliated with real estate. And he's a GoBundance brother. And yeah, amazing story. You're going to be educated on some incredible stuff today. So Ryan, welcome, brother.
Thanks, Jamie, for having me. Really excited to be here.
Of course. So let's get your first off. How old are you? This always makes me feel inadequate and insignificant. But how old are you?
I'm 25 right now.
25. Let's just let that sit for many of us for a moment. But why don't you give us your backstory? Let's start there. I can't believe you've done what you've done at 25. It blows my mind. I wish I had your mindset. But go back and tell us a little bit about where you're from, your beginnings, up through what you're doing today, if you don't mind.
Yeah, totally. So I grew up in Silicon Valley. Wanted to be, kind of an entrepreneur growing up. Ended up studying at UCLA, computer science, and going into kind of getting a first taste in the startup world when I was at school there, taking a company through the UCLA accelerator program during my last year, and then landing eventually at Google as a software engineer, and then turned into a program manager. After that, I worked at Google for about 2.5 years, and kind of the last maybe year to year and a half, started realizing this something was off, and what felt off was kind of the incentive structure of this 9 to 5 work job, where you're incentivized to kind of do as little or as poor work as you can do, and get away with it. And I'm not saying that's what you should do, but I'm saying that that's what you're economically incentivized to do. And I just don't really like that incentive structure as someone who kind of tends towards the entrepreneurial side. And so I kept looking for where can I put myself where I can trade my efforts, my time, my effectiveness for results for myself, as opposed to kind of the inverse here. And then eventually landed on real estate as being at least one of those vehicles. So looked towards real estate as a high confidence way to build horizontal income and kind of escape the need to work a 9 to 5, maybe salaried job in the more traditional sense. So eventually, I think started working on real estate about a year into my job at Google. And then January last year, which was the 2.5 year mark, left and went full-time onto real estate. Since then, have been working mostly as an investor syndicating, originally in the multifamily space, and then transitioning over towards commercial assets. So that's retail, industrial, office buildings. We've done hotels, we've done mobile home parks, and all of those kind of assets.
Okay. All right. I want to go back a step here, back to incentivized to do little or poor work. What do you mean by that? Explain what you saw. That's interesting to me. I agree with it. And I think that's a brilliant way of putting it, but I'm curious to hear you kind of articulate what you saw and why that is.
Yeah, totally. I actually have been seeing this not just with myself, but with a lot of others in the pandemic. I think kind of put the foot on the gas pedal for a lot of people to make this realization and make a jump that they were already kind of inclined to make. And I think what a lot of people are realizing, and their subconscious realizes it before their conscious mind might realize it, is that at work, you show up every day and you're going to get paid the same amount every day, no matter what, and if you do amazing, you might get a raise or a promotion that will result in more responsibility. And so there's two kind of, my mind breaks into these two models that are at play. One of them is that the more I work, I will get, my reward is promotion, which comes with more responsibility and more pay. And my pay will increase linearly, but my responsibility will increase in the sense that it will go from a 40-hour work week to a 50-hour work week to a 60-hour work week. And every 10 hours that I lose on my free time is an exponential loss on my free time. And so what I was realizing is this reward system is you get, this linear increase in pay, and you get an exponential decrease in your free time as you get rewarded more and more. And I kept seeing it as people would move up to managers, to directors, to VPs at these companies. They were working, they go from 40 hours to 50 to 60 to 70 to 80, and all of a sudden all their free time is going 100% of it. And so I just realized that's not an incentive structure I was interested in. And so instead, the other option is to work as little, or produce as little and work as little as you can and get away with it without getting fired. And honestly, that's just not someone that I am. I can't do that long term. And so I like to pour everything I can into the work that I do. And so I started realizing this is just not the place for that, where you can pour everything, every ounce of your energy in and be rewarded for it on the other side. And so I started looking for other opportunities where can I do that? Where can I put, my heart and soul into my work and then be rewarded appropriately for it.
Amazing. Wow. No, I love the way you put that. I'm curious, like, what do you think that, because you think about like in the entrepreneurial world, the higher you go, if you will, like the more you build your team and the more you build your organization or whatever, like there's less time involved, right? You build systems so that folks at the line level are doing more work. What do you think creates the inverse? Is it just the need of a corporation to grind you for the pay that they're giving you? Like, or is it just a mindset thing on the part of the employee? Like, is it the institution or is it the people that feel they need to do that? Do you think, from what you observed, work more as they go up the chain?
Yeah, I think that's a good point. I think a lot of people don't know what they're out there chasing. And
Oh,
if you
wow.
don't choose what you want, I think society will choose for you. So if you don't sit there and say, what do I want out of life? And you ask why, and get to the bottom of it, and you realize like, maybe for me it's happiness, or it's gratitude, or it's a certain amount of freedom. If you don't choose that, society will generally choose for you. And society will choose for you a lot of the time is often status, or status or money or something that can result in a life that's not that desirable or not that enjoyable, I should say. So I think a lot of people are out there, chasing status because they've grown up their entire life thinking, I want to work at the biggest company. I want the biggest title. I want the director or VP or whatever stamped next to my name. Why do you want that? I think most people couldn't answer that question because they haven't thought about it consciously, but they've been primed over decades of a culture to chase that kind of thing. And if you don't take the time to do the work and sit down with yourself and figure out what you want, I think that's the default. And your subconscious will kind of default to whatever culture and society primes it to do.
Where were you? Where were you when I was 25? Because you just described me. That's exactly what happened. Like I chased the title. And my story, people that listen to the podcast hear it all the time. My story is I I got the job I wanted, and I was like, oh God, this isn't who I want to be, right? But it took me to 40 to figure that out. You're figuring it out at 25, which is unbelievable. But when you say that, I'm curious. For you, you go why? What is it for you? What is the why, the base why, the root cause, the root of what you want in life? Have you defined that for yourself?
Yeah. I think if you ask when you start asking why, it's a really dangerous game. You can go down this rabbit hole. And what ends up happening is you ask why enough times, you get to the bottom of it, and you
Yeah.
realize at the end there is no objective truth as to what you should chase, and there's no best answer or optimal path. You're left with a subjective choice of what's going to matter to you, and you just kind of got to choose. And for myself, other people will choose very different things. For myself, what it ends up being is I think the way people feel is very important, including myself. And what I'm chasing is the best feeling that I can get throughout life, and hoping to increase the way that other people feel, in their normal life. And so, if you went out there and you interview, if you ask like Elon Musk what he's chasing, a lot of, or what he's trying to do for humanity, a lot of it is about protecting, extinction. It's a different why, right? It's not necessarily about how people feel along the way, along that journey. But I think for me, that's extremely important because I think there's an increasing amount of lostness out there as it just becomes, honestly, a lot of base needs get met, and we're very, we have a lot of free time. We have a lot of ambiguity in our world to go and choose things, which is great, but hard to navigate.
Yeah. No, that's interesting. My wife has made this point about she grew up in the Dominican, right, developing nation, and this isn't statistically valid, but she's like, yeah, people aren't depressed there, and it's not because oh, it's just a happier place, but to your point, basic needs aren't covered, right? They don't know when
Right.
they're going to eat. Many don't know when they're going to eat next. They don't know where how they're going to take care of their children, so they don't have the ability to think about the choices that are out there. They don't have those choices. They have to do right. It doesn't make it better or worse, but it's just what you just described. Like we've got our base needs are covered.
Yeah.
Even if you're poor in this country, your base needs are covered and then some, right?
Yeah.
That's there's a lot of wisdom in that, man. That's
It's
incredible. Go ahead. What were you gonna say?
Yeah, it's really easy to find purpose, or I don't know if it's easy, but purpose comes to you when you need to provide for your family, right? And when you need to be able to satisfy base needs. And so for all of human history, purpose has come from help others around me survive and myself. And that's no longer like, that's kind of a given at this point, like survival. And now what do you do left with your time? And so it's a lot harder to derive purpose, I think, than it used to be. And so that's a little bit more missing and increasingly missing in society.
Love that. That's a tweetable line, by the way. I want to do one more from your past. You mentioned that you took a company through the UCLA. Did you call it the incubator? Am I right on that?
Accelerator. Yeah.
Accelerator. Excuse me. What? Actually, that's a better word. What? Can you tell? What was that? If you don't mind, I'm just kind of curious what that was. What was that business that you brought through?
Sure, yeah. It was an EdTech company. It's called Tutorfly. It's still out there. My business partner and co-founder at the time, he is still working on that project. But basically, what happened is my junior year in college, a friend of mine and I had a very similar idea out there that a lot of education. We both came from Silicon Valley in the Bay Area, and a lot of kind of the standard education model is too slow and too kind of one size fits all. And then the alternative is, $100 an hour tutoring and things like that. And so there's kind of this gap in the middle where people can't quite afford, $100 an hour for to help their kid, but they also, want something better than what traditional education or public schools are able to offer them. And so we ended up like going and looking for an option that could fit that niche, and found it through peer-to-peer tutoring, basically. So we found is that there was a huge value to having someone who just took the exact same class that you're taking, maybe with the same teacher, and did very well in that class, then go back and teach others. And that was valuable for two reasons. And it helped, one of the best ways to learn is to teach. And so it helped both sides of the kind of the coin there. And you had a lot of students that were looking for ways to volunteer, looking for ways to help other, whether it was collect hours for their college apps or things like that. So there's kind of a missed value proposition there. So we ended up going to schools and recruiting schools through programs like National Honor Society and stuff like that. And we'd bring the entirety of the National Honor Society program, which were all usually school or students that were doing very well in school, onto the tutoring platform and have them connect with other students that were in their classes, maybe a year earlier or a year behind them. So that was the program. There was some tech involved, and I was helping with a lot of the engineering and trying to create this marketplace, basically. And so it was a mixture of software development and leading a team, and then pitching to venture capitalists or angel investors and things like that. So it was a pretty unique experience. It was an extremely cool place to be in college, and it really opened me up to that startup world.
Are you out of the business? Did he buy you out? Are you on the board? Are you an equity partner still? Are you just an inactive equity partner? What does that look like now?
Yeah, I basically ended up leaving at the end of college, stepping in first time into any startup, didn't know what to ask for going in. And I ended up wanting to pour in a lot of time and effort and energy, more than I originally thought I would. And I realized, so I made the ask to step up to, let's be 50-50 partners on this. And that wasn't something he wanted to do. So we ended up just taking it different ways, because I was looking for something where I could be, pour in all my time and energy and be a 50-50 partner on.
Makes sense. Wow. That's again, your wisdom blows me away, to be honest with you. You have this mind for it, entrepreneurial mind. It's incredible to me, for anybody, but especially at 25, not to keep pushing that, but damn, man. I look back at where I was at 25. I think I was in a bar somewhere. Like who knows? So to see what you're doing is inspiring. Take us forward to real estate. So you started syndicating multifamily. Was that the first dip into real estate? Were you just syndicating multifamily right out of the jump?
So I actually started buying some smaller, like triplexes and quadplexes out in the Midwest. When I first started working at Google, I had money coming in for the first time that felt real. It felt like this is a real amount of money. It's not a negligible amount. And I have to do something with this. And so at first I just kept funneling, X% of it into stocks and equities and things like that. And I would end up at the bar on a weeknight or a weekend or whatever. And I would say, do I want to buy this drink, or do I want to put this aside and put it into stocks and equity? And I knew I wanted to start investing and putting this money somewhere more useful, but the honest answer was I'd rather buy this drink. And, not like cracking under, an absence of willpower, but just to be completely honest, I think I would get more value out of this drink. And so I realized I needed a investment vehicle that was more exciting to me than stocks, which were extremely intangible. And so I went after kind of looking for an investment vehicle that was more exciting than that, and started looking into real estate. And I think listening to Bigger Pockets and things like that. And I got enough excitement behind that I started finally be able to store my money away and put it into real estate. So I started buying some triplexes and quadplexes out in the Midwest with one partner. But it was kind of this buy and then save, 6 months of saving, and then you have enough for down payment, buy another one, save, and it wasn't going very fast. So there was, over the course of the next year or so, I kind of had a growing frustration with the speed of that uh, entry point into real estate.
Yep.
Yeah.
Makes sense. Where were you buying in the Midwest?
We were buying out in Cincinnati, in Ohio.
Gotcha. Great city. You still own those properties, or no? Have you sold those?
Ended up selling them a couple years later, and they worked out pretty well.
Yeah. No, like a great market. I had no idea. I actually went down there, met one of the guys down there, a couple of the guys down there, Rolando, Bob Castellini. And my wife and I walked around like, man, I had no idea Cincinnati was such a gem. It's only a few hours from me, but what a city.
Yeah. Yeah. To be honest, I've never actually been there.
Neither had I until then. So,
but it does look cool. I've done a lot of research on Street View and otherwise.
Yeah, it's nice. It's nice. It's kind of like it's got a metropolitan feel to it.
Yeah,
is that the right word? Metropolitan, whatever. Not metropolitan. What the heck's the word? I'll think of it later. Cosmopolitan, whatever. Who knows?
To be honest,
Doesn't
they
matter.
all confuse me. All those words.
Yeah. Oh yeah. Something Allaton. Who knows? All right. So you buy these properties. Where does syndication come in? And talk to me about that whole business. Like what multifamily, where, what size, who's the partner, real partnership team look like? Give me kind of an idea of that multifamily business.
Sure. Yeah. So I said, we were buying these triplexes and quadplexes. It was going on very slow. And it was kind of a, I want to emphasize this part. This is a gradual transition, a lot of like building desire, building belief. That eventually landed in syndication. And it was not a flick of a switch or anything that happened. So it was over the course of a year, I started doing a mastermind group with the partner I was buying real estate in Cincinnati with, and one other who is Abe, who's my business partner now. And so we started doing a mastermind, and we all kind of concluded on the same goal of, we want out of this 9-to-5 world, and we want, to do that through, financial, some horizontal income and financial independence. And so with that, we didn't know what to do, how to accelerate this and how to go faster. But at least the desire was building, because every week we would sit there and talk about it. And so we wanted it more and more and more. And we were kind of upping the cost of not doing anything about it in our heads. And so eventually what we found is there were other investors out there that, we would talk to people about real estate. Every once in a while, we'd come up in conversation. Maybe it was at a bar, maybe it was at, meeting someone for coffee. And when talking to real estate investors that were a lot further along or had a lot more money, they were all saying, I'm looking for multifamily, if you can find them in any of these markets. And we kept hearing that. And there was actually if there was one moment where everything kind of shifted for us, it was at the beginning of the pandemic. I immediately went to Hawaii and then to Tahoe to just, get out into nature. And I was listening to a podcast, a Bigger Pockets podcast from another GoBundance member, Will Brown, who's now my roommate, actually. And his podcast on Bigger Pockets, he talked about deal flow is basically the bottleneck of all real estate, at least at the time. And there's plenty of capital out there. But if you ask people again and again and again, you'll notice a trend that everyone's missing deals. And if you can control the deal flow, that's the one bottleneck, then you can everything else will come in around you, which is the lenders, contractors, everything else. So for him, someone starting who's young and didn't have money, like control the deal flow. That's the hottest commodity in the real estate industry. And so we kind of already believed, had seen that trend and believed it a little bit, but hearing someone else say it and validate that idea gave us the belief that, okay, we should pour fully into that and we should double down or bet on that thesis statement. And so we ended up looking at multifamily as the asset class that we knew. To do that, let's go find larger multifamily that we can then bring in investors or wholesale to investors in order to take down bigger deals and kind of move the needle faster. So we ended up still, kind of kicking the tire for a couple of months, even after that, which is why, I don't want to say it happened all of a sudden, but eventually kind of the frustration built high enough. We ended up moving out to Reno, Nevada, which is where we kept hearing, the same investors. I live in the Bay Area. So a lot of investors were moving their money from the Bay Area to Reno. So we keep hearing Reno. Let's just move to Reno. We know no one there. All the distractions will disappear. All the desire to go to a bar or go, anything else. And we will just work on real estate. And so we moved out to Reno, Nevada. For the first month, we slept on air mattresses in a 1-bedroom apartment out there. And we just focused on deal flow. How do we generate deal flow? And what we ended up, coming to building was we ended up writing some software to message sellers or real estate sellers kind of at scale. And so we got to Reno within 3 days, we could message every property owner in Reno. And we did that in the multifamily space, which is what we were focused on. And then we would follow up with them and follow up with them. And so we ended up generating this pretty nice off-market, kind of deals list. And then using that to go to brokers and provide them value and say, hey, we have deals, we'd like to bring you on as a broker. And then kind of banking on them sending us deals in the future. And so, yes, we would give up a little bit of these deals on the entry point, but we would, see future return.
Yeah. Why would you give that up? Why would you not just go after the seller and take the deal then? Why would you go with the broker?
What we found is, brokers have different methods of getting to deals. And I think so they're banking off relationships they might have for 5 or 10 years and kind of word of mouth and things like that. Ours is a volume-based text approach. So it's totally different strategy. So the deals that we were bringing to the table are deals that nobody had ever, most of these brokers had never seen before. Whereas the broker network, kind of a lot of them have seen, a lot of these deals get passed around within the broker network. And so what we decided is, honestly, the 2 or 3% you would pay a broker, that commission is very worth it. Most of the time, if that's the price of finding a really good off-market deal, that's generally going to be worth it at the quality of deal that we were finding. So let's bring brokers on. Let's say, hey, look, on this one, I've already found the deal. I already, created that value, but I'm going to bring you on anyway and pay you for it. And what ended up happening is we could get in front of a broker that we would have no business being in front of, given our track record and age and other things like that. And we could jump to the very top of their buyers list by bringing them a deal. And we would have to pay, the cost of that is 2% of the deal that we would have, been able to keep. So we would bring, we'd show up with a list of 5, 10, off-market deals, and we'd say, hey, I need help with these. Do you want to broker these on our behalf? And they would say, yeah, absolutely. And we would close, 1 or 2 of them. And then, a month later, they'd be like, hey, I got this really good off-market deal. Do you want to take a look at it? And we would do that one, with them. And those would just keep coming in. So we found that the trade-off was just worth it because of you're investing in a future relationship that will pay itself back.
Long-term thinking, man. Wow. Okay. That makes sense. So, all right, I want to dissect this if you're cool with it. I want to kind of.
Yeah. Sorry. I was kind of all over the place.
No, I asked you to go all over the place. I said, hey, why the broker and all that stuff. I took you there. I took you on the tangent. No, you've been very clear on this. And for me, I'm trying to get into, like, I love text. I love SMS. I just think, open rates are way higher if you're doing any kind of marketing. We're talking about that. Mark Henteman.
Yes. Yeah.
So Mark and I are part of the quantum team, right? Actually heading out after this interview to Denver to look at a property we have under contract out there, right? And I've been talking to him about on our marketing efforts. What my role in that company is now. And again, met him at GoBundance. There's a plug for GoBundance, right? Met Mark at GoBundance, became a general partner with him. But we is text message marketing, or text message, at least not marketing in the way you're marketing and finding deals, because he's at this point where his broker network is robust. Like, he's already at that top of that list, right? But in marketing quantum and marketing what we're doing, using like text as the medium, not just email, right? Like email, what at 20% open rates, maybe. Text is still, I think, 90 plus, 95, 96% open rates. So I get why text. First question that comes to mind is, how do you get the list of, you wrote software, so I'm sure there's a lot of granularity to this, but like, are you using similar technology to like a Reonomy, that sort of thing, to get at the owner and then their phone number and then text that phone number? How do you get that?
Yeah, great question. So we actually do use Reonomy to pull the initial list. So that's just a list of addresses and properties.
Actually, Reonomy, not just.
Yeah. So that's where we start. You can use, Reonomy does all of it. You can pull phone numbers from Reonomy if you pay Reonomy. I don't find the phone number quality to be very high. So what we did early on is we A/B tested. We kind of broke this up into different segments. So you have the original property list. Then there's a translation from entity names into owner names. And then there's a translation from that to phone numbers. And then from phone numbers, you send text messages, and there's ones with higher and lower conversion rates. So I was working at Google. My partners were at PayPal and Amazon. And so we're all from this tech world. And so we A/B, in the tech world, you A/B tests. That's what you do. And so we took all of these segments and we said, okay, let's put 1,000, leads through this part of the pipeline, and let's see what comes out the other end. And let's, back check against what's correct. So we A/B tested along each side, or along each segment. And you find that there are better and there are worse services at each part of the chain. So if you use Reonomy for the whole thing, you can. It's easiest. Your data quality will be lower than you can do if you kind of piece together the best service at each segment of the chain.
Interesting. Okay. And that's what your technology does. You figured out the, by A/B testing and kind of testing again and testing again, you figured out the funnel, if you will. It's, my
Yeah,
speak for it, right? From going from a Reonomy and then tapering it down to the optimal list. Like this is the highest quality list we can text. Okay.
exactly. So originally we built that kind of out ourselves because we didn't realize it existed and we didn't have the money to pay for it, even if we knew it existed. But now, then, fast forward a year and a half or so, when we realized, oh, all these softwares exist out there, we could just pay for them, buy them, and then we wouldn't be sitting here like our code broke, we need to fix it so that we can continue marketing, which is
efficient.
Not a good process. Yeah.
Okay. So you're texting owners. So you figured out the optimal list. I'm actually kind of curious. So and maybe it's no different. When you text owners then now, what do you send them? Like, what do they get? Is it just like, hey, I'm Ryan, you don't know me, but I want your property? Like, what is it? Did you test different scripts? I'm curious what you actually say to them.
We tested a lot of scripts, and what we landed on is, hi, my name's Ryan. I'm interested in this property. Is there a price you'd sell it for? Is there a price you'd let it go for? That's
simple. That's it.
Simple.
What's open rate? I'm assuming is in the 90s.
It's very high. Yeah, it's probably in the 90s.
And what's go ahead. I'm sorry. I'm all excited. I want to get all these, but go ahead. I don't mean to cut you off.
Yeah, what we found is usually the first text, so I've done this two different ways. We've done this in Reno where we texted and followed up and followed up and followed up because we were there for about a year. And so, or a year and a half. So there was a lot of follow-ups. And then after that, we realized, why are we limiting this to Reno? Let's go broader. And so then we've done this kind of more nationwide, in which case we just do a first pass and we don't do a follow-up after that. So when we do the follow-ups, what we find is the first message, if we just come in and say, hey, my name's Ryan, I'm interested in this property, is there a price you'd let it go for? The response rate with a price is around 10%. But you can follow up and you get about 10% more. And slowly that starts to diminish. So it might be 10% the first time, 10% the next time, then it's 9, then 8, and it trails off. But at the end of the day, you might get a response from 50 to 60% of the people you message on what their price is. Now, some of those prices are absurd and outrageous, or they're assuming you've already done all the work, so there's no reason to buy it. But a lot of them are quite good. So that's probably the rate. But now, since we kind of opened it up and we're looking more nationwide, we generally just do the first pass and don't deal with the kind of diminishing returns of following up and whatnot.
Wow. Okay. So, wow. All right. How many operators are doing? There's technology out there, so this is not like completely unique at this point. Like you've built it, but there's other people that have built it and scaled a business out of it. You're a subscriber to those businesses now. Is this a fairly common tactic amongst operators right now, or no?
Depends. Single family home wholesaling, yeah, it's very common. It's done a lot. In buying $10 million commercial real estate, I haven't heard of anybody else doing it. So it depends on where you're at and what you're looking to buy.
Yeah. All right. So let's get into this part of it then. So you text 100 people. I don't know how big the list is, but you go into a market. So I'm assuming like you're in Reno. If you're in Reno, okay, every property, every multifamily property in Reno, maybe there's a filter to that. I want to text all of them. What's your price? Right. So you text, 1,000 people. What's your price? Right. You said 600 of those might respond with a price, right? Okay.
At the end of the day, that's after many follow-ups. Yeah.
Right. Yeah. Not like text out, text in. Hey, I got 600 leads. Cool. We're ready to go. How do you vet and determine that a price is ridiculous versus a price being reasonable? Like I'm just wanting to work once 600 texts come in or however many it is. Like, how do you get that to a place where you can determine not worth it? Is that systematized or is that 1-to-1 to 1-to-1?
Good question. Yeah. So I would say it's kind of evolved over the time that we've been doing this. So in the multifamily space, we knew Reno well enough where you didn't need to tell me anything about your property. You just tell me the price you're willing to sell for. I'll look up the address, find the square footage, the unit counts. I could do the performer rent and get a rough estimate on the rehab. So I don't need to know really the condition or anything else in order to get to an offer. So just your price, and that's enough. And that would be a one-off. And we were doing all the texting and we were doing all the analysis at that point. So that's the way, that's not very scalable. I don't really recommend it in the long run, but sometimes in the short term, it's necessary because you need to become the expert where you can derive formulas and playbooks and things like that and put someone else in that spot or automation or whatever it is. Now we focus on commercial real estate, and a large reason for focusing on commercial real estate is that it is both more complex, but also kind of simpler. And what it what we look for is we are looking to buy vacant buildings for vacant pricing, basically. And then we want to do the work, the value add to place tenants. And so I'm looking at what is the kind of stabilized value of a building based on what's market rent around here and how big is this building in terms of square feet. That's, this is the value I can get to. And I just want to buy at a price that's half of that or less. So if I'm buying for $1 million and I can get to 2 million after I do the value add, then that's interesting to me, and I'll look at it and potentially make an offer. So our systems will filter out anything that doesn't meet that criteria.
Now, you're doing this in one market at the beginning, or are you in multiple markets now? Is it just, you said national earlier, so are you just anywhere?
Yeah, now we'll buy anywhere. I don't really like California. That's probably the one state I would try to stay away from, but pretty much everywhere else. We definitely have some preferences, some heavy preferences towards the Southeast. We really like North Carolina, in Nevada, and then otherwise, generally the Southeast area.
Give me an idea of how many texts go out. I know you're using a service, but how many texts go out a week, a month, a day? I don't know what the volume, the best metric for that is, but how many texts go out in a month, let's say?
Yeah, if we're running full steam ahead, because sometimes what ends up happening is we throttle this down because of there's too many escrows or something like that going on at once. Yeah. But if we have if we're trying to send as many texts as possible, we will send. We're contacting about 6,000 properties in a market usually, and we might have 5 or 6 of those markets going at once. And so in a week, like the first week we enter all those markets, we might send out 30,000 messages, something like that.
You'll get 15, 20,000 responses from those eventually after multiple attempts.
If we were following up, but we haven't been following up as much recently. We've just been doing a first pass through markets because playing more breadth, less depth.
Okay, so 30,000, 5 markets, 6,000 a piece. How many actual let's start at the bottom. How many deals do you do out of that campaign? How many do you actually get under contract?
Yeah, get under contract probably around 20, and how many we do probably around 10.
So 20 under contract, 10 that actually come to close. How many of those do you make an LOI? How do you put an offer out on?
Yeah, we kind of skip the LOI phase a lot of the time. We've been burned on LOIs before. They get an LOI and then shop it around. So generally, when we submit an offer, it's the final offer, other than just kind of some going back and forth on text. So we will submit offers over text, which generally just include price, due diligence, timelines, and that's about it, to be honest. We'll submit that on, probably couple hundred properties, and see where, and then 20 will end up in escrow.
How do you get these around the broker? Because you bring them to the broker eventually, right? But I'm just thinking brokers right now, it feels like they're calling everyone, right? It's a hot market. They're trying to find deals everywhere. How are you it's just people that don't want to deal with a broker initially? How are you getting to these deals before that local broker does in whatever market it might be in? How are you? I can't imagine if I'm a broker, I'm like, wait a minute. How did you text a dude and then bring the deal to me when I'm here? How do I not know this guy, or how did I not get him first? Does that make sense?
Yeah, totally. We found a trend for a lot of the deals that we've done is these people have held these properties for a long time. A lot of times they've owned it for 10, 20 years. They're not a high transaction or high volume player in the market, and so they're a lot of times off radar to a degree. A lot of the time they only own one property, maybe they own 2. So they're not someone who's out there transacting every year or every couple of years, and a broker sees and says, hey, do you have anything else? There's kind of no entry point for a broker. And so, for example, the best deal we've done was a building that was built. The owner that we bought from was the original developer, back in the 70s, and then they did a big retrofit 20 years ago and placed a huge multi-billion-dollar tenant in there. But they haven't sold this building ever, and it's the only building they own. And it's about 30 minutes out of Raleigh, kind of in a more rural part. And so I don't know where a broker would enter the picture here. I don't know how the broker would ever meet this person or know this person. So there's a demographic out there that's kind of not tapped into.
Yeah, brokers have to love you for hey, found this thing. You want to come in on this? Like, oh yeah, you're a marketing agent for the broker. That's unbelievable. What
They
value, man? That's
either love or hate, depending on whether we come to them or something else.
fair enough. Fair
Yeah.
enough. So, all right. So you've got how long have you been doing this? Give me an idea of how many deals you've closed total since
Yeah. So
doing this.
we started the first deal we purchased was October of 2019. Is that right? Oh, I'm
Okay,
sorry, I'm off.
2 years
October of
ago,
2020.
so a year and a half ish.
Yeah, year and a half. So that was the first purchase we made. I think we've purchased about 15, have another like five in escrow. And uh, we've sold the first four of those and are in contract to sell two more.
Did you wholesale them, or what would you say you sold them? They're a year and a half. Like,
No, sorry, we've actually wholesaled a couple of times early on. Those are separate. So we've wholesaled three or four buildings.
yeah.
But I know I'm talking about sold. So the first property we bought was a multifamily building. We bought it October 2020. We did we rehabbed the entire thing and then found a buyer off market. So we sold in December of 2020. So we
Cool.
sold it in parallel to the rehab. So it was contingent on, we
Yeah.
closing out a rehab basically.
Wow. If you don't mind me
Then
asking, what were the numbers on that? Would you be willing to share that? Like, what did you buy for? What did
Sure.
you rehab? What did you sell for?
Yeah, no problem. We bought for 1.1 million. We put in 75K into a rehab. Didn't need a ton of work structurally or anything. Nothing major needed work, just cosmetics. So we put in about 75K into a rehab, and then we ended up selling for 1.55, like a couple months later. Then the next we had it was a group of investors. That was our original property. We actually came to Reno. We meant to wholesale property. That was the goal because we didn't have any money. We figured, what can you do when you don't have money? You can wholesale.
Yeah.
Syndication didn't really enter the picture or the mind yet. And we tried to wholesale this property and we failed at wholesaling it. Couldn't find a buyer because I didn't know anyone who wanted to buy, $1 million of multifamily out in Reno. The people we wanted or were talking to either wanted to buy $300,000 or they wanted to buy 10 million. And so there was no one for this. So, but we had done all the due diligence, and we're like, this is it's a pretty good property. Like, what if we just raise the funds? And so we kind of stumbled forward into syndicating on that first one.
So now, what does a standard deal look like? I mean, are these like you mentioned industrial property? Let's go back to multifamily. When you were just doing multifamily, were these like 10, 15 unit properties, mom and pop owned, like you were describing? Or is that the size, or were they much bigger? I'm picturing more that like 10, 20 unit mom and pop, like you mentioned. Yeah.
Yeah. I would say they started as mom and pop, about maybe $1 million to $3 million or something like that. That would be the range. And so we would buy 10 to 20 units and then flip those units. Now we're kind of buying a lot more commercial. So there's a lot of industrials, the main focus, but
Yep.
we're also buying some lab buildings, office, things like that. And so now they're getting into a more institutional size. We closed a building recently. It was about 200,000 square feet
Wow.
industrial building. And so they're getting larger and larger. But in theory, the projects that I would like the most is to buy from kind of the mom and pop size and then to graduate the building by placing tenants and renovating and whatnot into the institutional size and then to sell there.
Wow. Okay. All right. And you're buying these mom and pop buildings. You're graduating into sort of the industrial space. How are you raising capital? I mean, and again, we've mentioned your age, right? You're a young guy, new to the real estate space. I would assume the first deal was probably friends and family, kind of people that you're really, really close to. But like you're doing a lot of deal volume, and for anybody, whether you're 25 or a 50-year-old seasoned syndicator, you're doing a lot of deal volume. So you have to raise a lot of capital. How are you doing that? Is there a system to this, or how have you built a capital raising arm that quickly in a year and a half to do the kind of deal flow that you're doing?
Yeah. Well, okay. So originally, the first one's super hard, and now it's really easy. And I would say, for anyone who's like looking to raise funds out there, like the first time, five of us, the five guys on our team in a room, sitting around a whiteboard that I had, and writing the name of every single person that I knew who might have $50,000 or more onto a whiteboard. And we would go through and we'd assign names to everyone. Like, you have to call this person, you have to call this person, you have to call this person. I knew the product, like the product that we had was pretty solid. And so I didn't feel like I was selling something, that was really going to go south on people or anything like that. And the first time we went we built a decision tree of, everything that could go wrong on this property and what the worst case scenario is and what all the different outcomes. I didn't like showing people a pro forma that kind of has all these assumptions that they don't understand or aren't aware of. So I wanted to walk people through the full decision tree of like, here's what happens if the COVID rent moratorium lasts an extra year. Here's what happens if our contract, our rehab budget goes over by this, by double. Here's what happens if the business that we're going to master lease the building to one tenant. If they go out of business and we have to pivot to a traditional renting route, like there's just all of these kind of like, here's our business strategy and here's everything that could go wrong. And here's where you would land. You would get your money back in like 4% return. It wouldn't be that glorious, but you also wouldn't lose your shirt. And so I was trying to walk people through all of this. And so that thoroughness was there early on because I knew that like, I don't have a track record to back it. So I need to back it some other way. And now that's changed a lot over time. We've done some of the investors, they're on their fourth deal with us or fifth deal with us. And so now it's more of a phone call. Hey, I have a deal. It's really good. Do you want to meet and talk about it? And we'll set up a 30-minute Zoom call and I'll walk them through the property and they say, this looks good. Let's do it. And they'll put, $500,000 in or whatever, like pretty big check sizes at this point. But it wasn't that way early on. People need to test the waters and they want to do it with smaller amounts and kind of see, they want to test a lot of things about how good are you at assessing deals and finding deals and how good are you at underwriting. And also when things go south, when things don't go the way that you planned, what will you do as a response? Yeah. And so I've held it as like we've tended, we will come in asking for decently large sizes of the profit a lot of the time. And that's because we will end up giving away a lot of that profit if needed. So our profit is the buffer on a lot of the deals. And so if things go south, it comes out of our side. And I think that's just an aligned.
What do you mean? Give me some numbers on that. What do you mean by that? Is it from a standpoint of like the fees you're taking or what your promote is, the splits? Like, what do you mean by that?
Yeah. We don't do fees, and we don't do promote. We don't do equity. We do. I guess we do a promote. I guess that would be more of a profit splitting. We don't do equity. Basically, the way I view it is as the sponsor of a deal, I don't want any of the value for me locked in when I close. I want all of the value to be earned after I stabilize the property. And I think that's an aligned incentive. I think there's a lot of structures out there that are equity based or fee based, where the sponsor may have gotten 90% of the value that they're going to get the day they close.
Sure.
And so I like to just align it. And we tried to keep it as simple as possible. And I found a lot of the fees just made things complex, and a lot of waterfall structures, equity structures, and things like this make things very complicated. So generally, the way we came in is we're going to get you back all of your money first. And then after that, we're going to split profits 50-50 or, whatever the split would be. And so that said, on various deals, like when things, I communicated, here's the way the structure is going to work or the deal is going to work. And then last second, we had to pivot to a different loan that with higher fees. That's going to come out of my, I'm going to eat that cost. And so that's going to come out of my profit. So anyway, that's generally the way I like to run deals. I think it makes it straightforward, and a confused mind says no. So I wanted to keep it very simple and easy, but also wanted to make sure that incentives are aligned along the whole way, where I got to do the best thing for the project because otherwise I get nothing out of it.
That makes sense. No, I like that. So you're essentially saying, hey, look, you get 70-30 splits, all that. That's kind of the standard that you hear a lot in the syndication world. You're saying you're going to get 50. Because anything that comes out of whatever, anything that goes wrong, it's coming out of my 50. So yeah, I might be asking for more up front, but if it all goes great, you're going to do well because I'm not going to have to take anything out of my side, but you're going to get your 50. You don't have to worry about, I guess you'll get your 70, but you don't have to worry about a diluted 70 because I'm going to take whatever losses there are essentially out of my side or any things that happen along the way.
Right. And a lot of that's like, we don't do that contractually, meaning like I don't state in there like I'm obligated to take on all the losses. That's just something we've done out of habit. Whenever anything does go south, we'll come back and say, hey, this thing went south. We're taking it out of our side.
It's good sponsor. And sure. Yeah. No, that makes sense. Wow, man. Interesting. So you've scaled fast. You're raising capital fast. You're doing a bunch of things really, really, what's next? Like, what is the next level for you? Where do you take this?
Yeah, so right now what we're working on is we've kind of got all these pieces that work. They were born out of a fast-paced startup kind of environment, and so they're very chaotic, and they're not, the systems aren't amazing or great or dialed in extremely well. So it works very well, but it takes a lot of your time and your energy and your effort to kind of keep the engine going. So right now, what I'm working on is building those systems, and that can be automation, or it could be systems that I'll hire people into, so that this thing can just work in the background more or less a lot of the time. So I'm trying to reduce the amount of effort and that I need to put on a daily basis to make all of this happen. I'd like to get to the point where it's just phone calls talking strategy, and that's all. That's my involvement in here, and no more sending the same docs to lenders, time and time again, or sending, scheduling inspections and all this stuff. So I'm working on those systems right now and trying to reduce my time and energy that I have to put into this. And once that's done, then I'm actually probably going to look into a next venture. And it might be real estate related, it might not be, but I'll be looking towards some new business.
I like it. I'd be remiss if I didn't ask, are you able or willing to share what technology do you use for your texting platform?
Yeah, happy to share. I use Reonomy to grab the original lists. We use for getting owner names and things like that, you just have to go on to county websites that are out there, or usually actually state, like Secretary of State websites and stuff. Then for skip tracing, we'll use Elliott Smith. He's actually a GoBro. His service, when we did A/B testing, his service was the best. You can also use Skip Genie as our kind of backup whenever they can't find certain numbers. And then we'll use Lead Sherpa for messaging, SMS messaging, but I really think you can use any number of messaging services out there. In testing, A/B, I didn't find a huge difference between all these services. And then we'll use Podio for our CRM, and that's primarily just because it integrates with Lead Sherpa, so that you can easily push leads to the CRM. If anything else offered that service, it'd probably be equally valid CRM.
Makes sense. Wow. So all right, there's quite a few steps. I'm curious, what's your all-in cost monthly subscription fees on all? Because Reonomy ain't cheap. I don't know what Elliott's program is, but like, what do you spend a month on marketing?
Yeah, you can do this in any number of ways. So you can kind of dial up or down the marketing costs, and the other end of the spectrum is effort. And so originally we coded it all up, and our marketing costs were like $1,000 for the year. And we messaged all of Reno and time and time again, went through. Yeah. So that was that's one end of the spectrum. The other side is you put all the dollars in, you get a Reonomy subscription, you have Lead Sherpa accounts, and all the other services I mentioned. That might be you can probably go into a market for $5,000 in a market like an MSA for $5,000, just something like Raleigh Durham or something like that. And then there's the monthly cost might be $1,000 a month or something. So it's not free, and that's why early on we built it ourselves, because we were taking a big bet that this would even work. Yeah. Then once we proved that messaging people works, let's put money into it and let's scale this up. And so now that we're sure that it works, we're willing to put the money in.
I love it. Okay, let's talk a little bit about GoBundance. It's kind of a two-part. Like, why GoBundance, and what has been the if anything, what's been the benefit of being a member for you?
Yeah. So I actually originally joined GoBundance on a recommendation of Will. I mentioned him earlier, Will Brown. And when I met him for the first time, actually no, I hadn't met him for the first time yet. I took after that, I listened to that podcast. I called him and I said, "Hey, I really like what you had to say." I asked him some questions. He gave us some advice. That's what landed us in Reno, and started, kind of this more action-oriented endeavor. And so I called him about a year later and said, "Hey, I want to thank you for, the advice you gave us, so that this is where we landed, and it worked out really well." He said, "That's awesome, man. You need to come down to LA. We got to meet, and you got to join this group, GoBundance. I think you'll love it." So that was how I kind of got introduced to the group. Ended up joining, and I was really looking for, I'm really looking for, even currently, kind of a reintegration to normal society a little bit, because I went, when the pandemic started, it happened to be, we were doing a mastermind retreat the weekend that all of the emails went out to work remote. And what we decided was, or the question we went to answer, we kind of extended that retreat to a week out in Hawaii, and we were trying to answer one question, which was, what can we do this year that will be more effective than it would be on a normal year? Because the world's about to kind of change here. And we realized we can put our head down and work really hard. And so we moved out to Reno to, eliminate all those distractions and whatnot. And so as of, throughout the pandemic, I was working really hard, but I was also, to a degree isolating myself, with a group of friends that we were working on this project turned company, but it was fairly isolated. And so GoBundance, it's been a huge way for me to reintegrate back into, the multi-dimensionality of life. It's not all about working as hard as you possibly can all the time. And so there's this very balanced, focus on kind of a better balance of things in life. And so that's been really, really helpful for me to readjust and refigure out what I'm missing, or what I was not focusing on for the last year.
Yeah.
So to answer your second question, sorry,
Yeah.
go ahead.
No, go ahead.
Yeah, to answer your second question of what I've gotten the most out of in GoBundance, I used to be a person of extremely high gratitude in college, and so I remember a lot of times just walking through campus or going on hikes and just kind of like just listening to music and tears coming down my face of just gratitude of like I'm so lucky to be here, and I like that to be a key part of my identity. And I remember joining GoBundance and filling out the one sheet for the first time the first week, and filling out the life happiness index. And the last box on there is the gratitude thermometer, and filling it out, I'm like, I have to put I have to put a 5 here. And it was kind of a conscious slap in the face of having to realize and state out loud where you're at on something that once and still you want to mean so much to you, which is gratitude. And so it really helped me like get that back in check, just the acknowledgement that that wasn't where it wanted to be. And it was just, everything was work and focus, and a lot of times you lose yourself in that pushing really hard towards a goal. And there's excitement and adrenaline and other good feelings in there, but gratitude is a unique feeling of I think of appreciating what you have. And that had really slipped a lot. So GoBundance, I think if it's the one thing that helped me the most, I would say it's just making me think about that.
Amazing, man. Well, I'm like I said, blown away by all of this. I can think of about 20 people I need to send this episode to before it ever airs, because the what you just laid out here is unbelievable. And I want to be respectful of your time. So I'm going to kind of jump over the one sheet stuff and go right to the final question, which is out of the GoBundance card game, which is this: what's the most you have ever spent on a gift for someone?
The most I've ever spent on a gift. To be honest, that's a hard question for me to answer. I guess probably in the realm of hundreds if we're talking monetary value. But
Sure.
What I end up, I'm not sure that's the right way to measure gifts.
That's okay. Yeah, whatever,
Because
whatever.
I think, because I think what ends up happening is as we become more, as we are able to climb up kind of in a monetary perspective or build more horizontal income, there's other resources that end up becoming the constrained ones. And so I've been trying to get myself to focus on this more and more recently. Is my time and my energy I hold very valuable and very dear. And so I've been finding it harder and harder to give my time and my energy as gifts, where I used to give those things a lot more. And so I think the gifts that stick the strongest in my mind are actually not really ones that I spent a lot of money on, but that I went out of my way and spent days sometimes building for other people, building something that would mean a lot to them, or they had put a lot of meaning behind. And I'd like to do a lot more of that. It's a hard thing that I've been time has become more scarce.
Yeah. No, exactly. As you're building, and that's why you want to systematize your business a bit more. I completely get that, right? So you're not grinding through it. So, wow, man, this was unbelievable. Such just chock full of information, and I'm so glad Jake connected us. Like I said, we've been at a couple events together, just haven't crossed paths, I guess. But where should people learn more about you, your company, follow you, whatever you want to lay out there for them to find you?
Yeah, absolutely. If you want to see the projects we've done, westegrealestate.com. That's West Egg Real Estate.
West
and
Egg,
then
EGG? Is that what?
Exactly. Yeah.
Got it.
EGG. That's where you can find all the projects we've done. You can reach out to me. I'm pretty much only on Facebook. I don't have a lot of social media, or over email, just at like ryan@westegrealestate.com. And I'm happy to take, if anyone's at the part of the journey where they're willing to work really, really hard and they just need that little kick of belief into how to do it, I think that's where I can probably be the most helpful. So I'm happy to help anyone who's in that position.
Amazing. Appreciate you being on here, brother. Thanks for dealing with all of my questions. I feel like I peppered you through this thing, but so fascinating. Just very interesting what you're doing. So I appreciate you being here, and I hope to see you at the next one.
Awesome. It was great meeting you, Jamie. Thanks for having me on.